James, wow.
Yes, look, the numbers don't look good. And remember, there may still be, in fact, a McDonald's effect in there too. So if you allow for up to 40,000 workers that aren't going to be hired next month by McDonald's, the underlying story could even be substantially weaker than the very soft numbers.
Almost in negative territory.
That's right. I've got to say, I'm impressed. I mean, it looks like payrolls for once is actually reflecting what really does seem to be going on in the economy. Now, they say there's no real weather effect in there. You can never be totally sure about that, and we certainly know that the Japanese parts issue is weighing down on the industrial sector. So it's true there could be some one-offs weighing down on the numbers as well. But the underlying story is clearly softening in the labour market, even allowing for those factors. The US economy, look, it's going to struggle to better a 2% growth pace, I think, in any quarter this year. And so, you know, a lot of economists are going to have to sort of pull back.
But are we heading into double dip?
No. I think we're just heading. Well, we're into. This is it. This is what is in store for the US economy. Okay. This sort of, you know, slightly sub 2% growth pace. You've got the headwinds of households wanting to save more. The housing market itself is still very much in the doldrums. You've never had a decent recovery in the US economy without housing being a key participant in it. You've got the governments at the state and local government level laying off workers. You've got the federal government's got issues now as well. These gasoline prices acting as a tax on consumers. All of these factors are going to prevent the economy from accelerating from where it is at the moment.
So then, James, this must put Bernanke and company in a bind then, right, with quantitative easing?
Our house view at Westpac is that there will be probably a third round of quantitative easing by early next year.
Probably or now likely?
No. Our house view is there will be another round of QE. That's our base scenario. The thing is, Bernanke's saying at the moment that the trade-off between growth and inflation has become much less favourable with any further QE at this stage. I think what they'll do is tweak the program, maybe target different assets, maybe sort of quasi-sterilise some of it to try and separate the QE3 from QE2, which is very much blamed by some for the higher inflation numbers we've been seeing of late. QE3 will be aimed very much at trying to get the labour market working again.
To get this working, although that's what I thought QE2 was for as well.
Well, no, that was more about avoiding deflation.
Okay. Mike, John, Sarah standing by. Mike, take us through some more of these numbers.
Well, it's kind of interesting because you can see some of the arguments made for temporary weakness in these numbers. We had 9,000 jobs lost in transportation manufacturing, 3,000 in cars, and there's been interruptions to the assembly lines because of the Japanese earthquake. So theoretically, those could come back. Had a lot of bad weather problems and some strange situations in terms of the seasonals for retail sales, and we saw a drop in retail sales as well. So there are some possibilities that this is just temporary. So it's going to take a while before you can make an argument for QE3, Betty. In terms of the unemployment rate, that's all more people coming into the labor force, up by 272,000. Jobs gained and jobs lost in the household survey, just about even.
Okay, and John, I know you're watching as well the markets along with Sarah and Peter there. Give us a take on, you know, now that the markets have digested it for a few minutes, what's going on here?
Well, this is a big sell-off, and remember we had that huge sell-off on Wednesday in reaction to ADP. It was the biggest sell-off we'd seen in the year, Betty, and a lot of people were wondering, could you see a big move in the market today after the big move that we saw on Wednesday? It hasn't happened a lot over the last year. And remember, we haven't seen some big moves in either direction generally on Jobs Day. But the reality is a lot of people were caught off guard by that Wednesday number. We had been seeing a huge rally in the markets. When we started to see the weakness in the jobs market, it was during earnings season. When the jobless claims started to look ugly, it was during earnings season. You were hearing great stories about corporate profits, so people were ignoring that news, and all of a sudden you get hit by a Mack truck on Wednesday, which means maybe not all the selling was done, especially with this kind of number.
Right, and before I get to Peter, I mean, James, you know, I saw you nodding your head when John was talking about that.
John's absolutely right. I mean, look, on Tuesday we had some weak regional surveys from some of the district Fed offices and some weak housing price numbers, all ignored because there was some other good news going on at the time. But they couldn't ignore it on Wednesday, and they certainly can't ignore it now. I mean, there's been this unjustified optimism, I'm afraid, about the US economy, with people extrapolating a bit of a bounce in auto spending and capital goods spending into something that can last quarter after quarter after quarter, when the reality is they're just one-offs. The one-offs are to the upside. You know, and I think the underlying story is actually very weak here in the US, I'm afraid.